Right now, at this very moment, the financial markets are closed. The price of silver sits frozen at $31.47. But in exactly 6 hours, at 6 p.m. Eastern Time, something unprecedented will happen. $50 billion in institutional capital, money that has been sitting idle for 2 weeks, will flood into a market that has no supply left to absorb it. The vaults are empty. The dealers are sold out. The miners are holding back inventory. And the pension funds? They have no choice. Their algorithms are forcing them to buy. Tonight, when those markets reopen, the largest forced buying event in silver's modern history begins. What happens next will either validate everything you've been told about market mechanics, or it will expose the greatest fragility in the global financial system. The clock is ticking. Welcome to Financial Revelations. If you've been navigating the markets for decades, if you remember when a handshake meant more than a contract, if you understand that real wealth isn't built on hype, but on understanding the machinery beneath the surface, then you're in the right place. We don't do predictions here. We do analysis, cold, calculated, based on the numbers institutions don't want you to see. Now, before we begin this investigation, do me a favor. If you appreciate research that treats you like the experienced professional you are, hit that subscribe button. Not for us, for yourself, because the information we're about to share is not going to make headlines until it is too late. And drop a comment below. Tell us where you're watching from, New York, London, Singapore. Let's see how global this audience really is, because what's about to unfold in the silver market, it's not regional, it's systemic. Let's begin. On the first day of January 2026, the world's financial markets exist in an unusual state of suspension. The exchanges are closed, the trading floors are empty, and the price of silver remains locked at exactly $31.47 per ounce. To the casual observer, this appears to be nothing more than a standard holiday pause. The markets will reopen, trading will resume, life will continue as normal. But beneath this temporary calm, a mechanical process is already in motion. A process that operates independently of human emotion, market sentiment, or economic optimism. This process is called institutional rebalancing, and it happens every single year with mathematical precision, regardless of what investors think or feel about the markets. Here's how it works. Pension funds, insurance companies, sovereign wealth funds, they do not invest the way individual traders invest. They do not wake up one morning and decide to buy silver because they watched a compelling video or read an exciting article. These institutions operate under strict contractual mandates. Their investment committees meet once per year, typically in late December, and they review the performance of every asset class in their portfolio. Then they apply a formula. If an asset outperformed the portfolio average, the mandate requires them to increase their allocation to that asset. If an asset underperformed, they decrease their allocation. This is not optional. This is not a recommendation. This is a binding fiduciary requirement written into the legal documents that govern trillions of dollars in global capital. And in 2025, silver did something it rarely does. It became the single best performing traditional asset in the entire institutional investment universe. While stocks delivered moderate returns, while bonds struggled under rising interest rates, while real estate faced valuation pressures, silver quietly climbed more than 40% from its January 2025 lows. Now, the algorithms are running. The portfolio managers are receiving their rebalancing instructions, and those instructions are clear. Increase allocation to silver. Industry analysts have calculated the numbers. Based on standard allocation models used by the world's largest pension funds, approximately $50 billion in new capital must flow into silver-related investments during the first quarter of 2026. $50 billion. That number represents the mechanical requirement, not speculation, not enthusiasm, not a bullish bet on future performance, simply the mathematical outcome of last year's price movement. But here's where the situation becomes unusual. In a normal rebalancing cycle, when institutional money flows into an asset class, that asset class absorbs the capital smoothly. Markets are designed to handle large transactions. Dealers maintain inventory. Sellers emerge when prices rise. Supply meets demand. This year, that mechanism is not functioning. The physical silver market is experiencing something it has not experienced in over a decade: genuine supply constraints. COMEX registered silver inventories, the actual physical metal available for immediate delivery, have fallen to levels last seen in 2015. But in 2015, institutional demand was minimal. In 2026, institutional demand is mandatory. Major bullion dealers across North America and Europe are reporting delivery delays extending 3 to 4 weeks on standard silver products. Premiums over spot price. The additional cost buyers pay to acquire physical metal have risen to $4 to $6 per ounce in some markets. That is not normal. In a liquid, well-supplied market, premiums hover between 50 cents and $1.50 per ounce. When premiums rise above $4, it signals one thing: There's more money trying to buy silver than there is silver available to buy at current prices. And the mining companies are not helping. Traditionally, when silver prices rise, mining companies increase their sales to take advantage of higher prices. They forward sell their production. They clear their inventories. They maximize revenue. But in late 2025, several major silver producers quietly changed their strategy. Instead of selling aggressively into rising prices, they began holding inventory. They restructured forward contracts. They signaled to the market that they believe current prices do not reflect future value. This creates a problem, because when the electronic futures markets reopen tonight at 6 p.m. Eastern Time, that $50 billion wave of institutional capital will enter a market that has no intention of supplying silver at 31.47 per ounce. The pension funds have a mandate to buy. The market has no obligation to sell. And in that gap between forced demand and restricted supply, price discovery is about to become violent. There's a number that Wall Street does not talk about publicly. It sits in a database maintained by the Chicago Mercantile Exchange, updated daily, visible to anyone who knows where to look, but rarely discussed in financial media. That number represents the total amount of physical silver available for immediate delivery in the COMEX system. As of December 31st, 2025, that number stands at 267 million ounces. To someone unfamiliar with the silver market, 267 million ounces sounds like an enormous quantity. It sounds like abundance. It sounds like there's plenty of supply to meet any level of demand. But context changes everything. The global silver market consumes approximately 1.2 billion ounces per year. Industrial users, electronics manufacturers, solar panel producers, medical device companies, they require silver not as an investment, but as a raw material for production. That means the current COMEX inventory represents roughly 80 days of global industrial consumption. 80 days. Now add the incoming institutional demand. $50 billion attempting to acquire physical silver exposure over the next 90 days. At current prices, $50 billion purchases approximately 1.6 billion ounces. The math reveals the problem immediately. The available registered COMEX inventory could satisfy approximately 16% of the incoming institutional demand if industrial users stopped consuming silver entirely, which they will not. This is not a temporary imbalance. This is a structural impossibility. But the situation extends beyond the COMEX warehouses. In London, the global center of wholesale precious metals trading, a similar pattern has emerged. The London Bullion Market Association vaults, which store silver for institutional clients, central banks, and large trading firms, reported a net outflow of 89 million ounces during the fourth quarter of 2025. That silver did not disappear. It moved into private hands, wealthy individuals, family offices, sovereign entities that do not report their holdings publicly. Once silver enters private vaults, it does not return to the market easily. These are not traders looking to flip their positions for a quick profit. These are long-term holders who view silver as wealth preservation, not speculation. The retail dealer network tells the same story. In the United States, major bullion dealers are quoting premiums of $4.50 to $5.80 per ounce over spot price for standard American silver eagles. In Europe, premiums on Vienna Philharmonic silver coins have reached $6 per ounce. These premiums exist because dealers cannot source inventory fast enough to meet retail demand. When a dealer sells a silver coin to a customer, that dealer must replace that inventory by purchasing from a wholesaler or directly from a mint. But the wholesalers have limited stock, and the mints are running at maximum production capacity, unable to increase output without months of lead time to expand operations. Delivery times confirm the supply stress. A customer ordering silver from a European dealer today should expect delivery in late February. That is an 8-week delay for a product that typically ships within 5 business days. An 8-week delivery window is not normal market behavior. It is rationing. And then there is the mining industry response, which may be the most revealing indicator of all. Silver mining companies operate on tight margins. When prices rise, conventional economic theory suggests they should increase production and maximize sales to capitalize on higher revenue. But in the final quarter of 2025, 3 of the world's top 10 primary silver producers made an unusual decision. They reduced their forward sales commitments. A forward sale is a contract where a mining company agrees to deliver silver at a future date for a price agreed upon today. It provides revenue certainty. It hedges against price declines. Most mining companies maintain forward sales covering 12 to 18 months of production. Yet these 3 companies, representing nearly 140 million ounces of annual production, quietly bought back portions of their forward contracts, paying penalties to exit agreements that locked in prices below $35 per ounce. Why would a mining company pay a penalty to avoid selling silver at $35 when the current market price is $31.47? Because their internal models are telling them that $35 will seem inexpensive very soon. When the producers who extract silver from the ground are unwilling to sell at current prices, when the vaults are draining faster than they are refilling, when retail dealers cannot source inventory despite paying substantial premiums, a message is being transmitted. That message is simple. There is not enough physical silver available to satisfy the demand that is about to arrive. The pension funds believe they are buying a liquid, tradable commodity. What they are actually trying to buy is an asset in the early stages of a supply crisis. And unlike previous supply squeezes that were driven by speculative enthusiasm, this squeeze is being driven by contractual obligation. The institutions must buy. The market cannot deliver. Price is the only variable left to adjust. December 31st, 2025, 3:47 p.m. Eastern Standard Time. In the final 13 minutes of trading before the New Year's holiday closure, something peculiar happened in the silver futures market. A series of large sell orders hit the market in rapid succession, not the gradual measured selling typical of institutional portfolio adjustments. This was concentrated, aggressive, deliberately timed to create maximum downward price pressure with minimal liquidity available to absorb it. Within those 13 minutes, the price of silver dropped 1.23 per ounce. By the closing bell, silver settled at $31.47, down nearly 4% for the day, erasing 2 weeks of gains in less than 15 minutes. To retail investors watching their screens, this appeared to be typical year-end profit-taking. Traders closing positions, funds locking in gains before the calendar turned. But to those who understand the architecture of the futures market, this was something else entirely. This was strategic price suppression, and the entities responsible were not retail traders or hedge funds. They were the commercial banks that serve as designated market makers in the precious metals futures market. These banks, typically 4 to 6 large institutions, hold a unique position in the commodities trading ecosystem. They are authorized to create and sell futures contracts even when they do not own the underlying physical metal. Their role is to provide liquidity, ensuring that buyers always have sellers and sellers always have buyers. In exchange for this privilege, they accept substantial risk, and as of December 31st, 2025, that risk had reached dangerous levels. The Commitment of Traders report, a weekly disclosure published by the Commodity Futures Trading Commission, reveals the positioning of different market participants. The most recent report showed that commercial banks held a collective net short position of 312 million ounces of silver. 312 million ounces. That means these banks had sold futures contracts representing 312 million ounces of silver that they did not own, betting that they could either buy it back cheaper later or deliver physical metal if required. Under normal market conditions, this strategy works flawlessly. Prices fluctuate. The banks profit from the bid-ask spread. They manage risk through sophisticated hedging models, and when delivery is required, they source physical metal from the COMEX warehouses or from mining companies with whom they maintain supply agreements. But the current market conditions are not normal. The COMEX warehouses hold 267 million ounces. The banks are short 312 million ounces. Even if they could access every single ounce in the registered vaults, which they cannot, because much of that metal is already claimed by other entities, they would still be short 45 million ounces. And now, $50 billion in pension fund capital is about to flood into the market, creating buy orders for approximately 1.6 billion ounces. The mathematics of this situation are unforgiving. If the banks continue their traditional strategy of selling futures contracts to suppress price, they will increase their short position even further. But every additional ounce they short is an ounce they will eventually need to deliver or buy back. And there is nowhere to source that silver at current prices. This creates what traders call a squeeze point, the moment when maintaining a short position becomes more expensive than covering it, regardless of the loss involved. History provides clear precedents. In March 2011, silver was trading around $35 per ounce. The commercial banks held a significant net short position. As investment demand surged, they attempted to suppress the price through aggressive futures selling. But the physical demand overwhelmed their ability to control the market. Within 6 weeks, silver reached $49 per ounce. The banks were forced to cover their shorts at massive losses. In August 2020, a similar pattern emerged. Silver was at $24. Commercial shorts were heavily positioned. Physical demand from solar, panel manufacturers, and industrial users exceeded available supply. By September, silver touched $29, and the banks abandoned their short positions, flipping to net long for the first time in years. The current situation contains elements of both episodes, but with one critical difference. In 2011 and 2020, the buying pressure came from discretionary investors and industrial users who could delay purchases if prices became unfavorable. In 2026, the buying pressure is coming from pension funds operating under fiduciary mandates. They cannot delay, they cannot wait for better prices. Their rebalancing requirements are contractual obligations that must be fulfilled within the first quarter. The The banks understand this. Their trading desks have access to the same portfolio models that pension funds use. They can calculate, with reasonable accuracy, how much capital will flow into silver over the next 90 days, and they have made a decision. Evidence of this decision appeared in the derivatives market during the final week of December. Several major commercial banks quietly purchased call options, contracts that profit when silver prices rise, while simultaneously beginning to reduce their net short positions in the futures market. This is not typical behavior for entities that have spent years suppressing silver prices. This is repositioning. The banks are not abandoning their market-making role. They will still provide liquidity. They will still facilitate trades. But the strategic objective has shifted. For years, their profit model relied on keeping silver prices range-bound, collecting spreads while managing a persistent short position. That model no longer works when incoming demand exceeds available supply by a factor of 6. The new model is simpler: facilitate the price discovery process, manage the squeeze rather than fight it, and profit from the volatility rather than resist it. When the futures market reopens tonight at 6 p.m. Eastern, the banks will not be standing in front of the $50 billion wave trying to hold prices down. They will be stepping aside. And in some cases, they will be riding the wave higher alongside the pension funds. This is not capitulation. This is calculated strategy revision. The question is no longer whether silver prices will rise. The question is how fast the banks can exit their short positions before the price moves beyond their control. At exactly 6 p.m. Eastern Standard Time on January 1st, 2026, a switch will flip. The electronic futures market for silver will reopen after its extended holiday closure. Within seconds, the first trades will execute, prices will begin to move, and the market will reveal whether the analysis of supply constraints, institutional rebalancing mandates, and banking sector repositioning is accurate. But understanding what happens next requires understanding how large institutional orders actually enter the market. Pension funds do not trade the way retail investors trade. A retail investor might log into their brokerage account, see that silver is trading at 31.47, and place a market order to buy 100 ounces immediately. The order executes in milliseconds at whatever price is available. Pension funds cannot operate this way. When a pension fund needs to deploy $2 billion into silver, and several major funds are facing exactly this requirement, they cannot simply place a market order. An order of that size would move the price violently before even half the position could be filled. Instead, they use algorithmic execution strategies. The most common strategy is called time-weighted average price, known in the industry as TWAP. The algorithm breaks the large order into smaller pieces and executes those pieces gradually over hours or days, attempting to achieve an average price that represents the market's true valuation during that period. Under normal market conditions, TWAP algorithms work efficiently. They minimize price impact. They allow large orders to be filled without creating dramatic price spikes. But TWAP algorithms are designed for liquid markets with deep order books and willing sellers at multiple price levels. The silver market that opens tonight does not meet those conditions. When the first pension fund TWAP algorithm begins executing buy orders at 6 p.m., it will encounter limited sell-side liquidity. The algorithm will purchase the available contracts at $31.50, then $31.60, then $31.75, steadily walking the price higher as it consumes the available supply at each level. Then the second pension fund's algorithm will start executing, then the third. By 7 p.m., multiple billion-dollar TWAP algorithms will be operating simultaneously, all attempting to buy silver, all encountering the same supply constraints. This creates a compounding effect. Each algorithm pushes the price slightly higher. That higher price triggers the next tier of sell orders, but those sell orders are insufficient to satisfy the cumulative demand. So the algorithms continue climbing, searching for the price level where supply finally matches their required purchase volume. Market analysts who have studied previous supply-constrained environments, copper in 2021, palladium in 2019, rhodium in 2020, have identified a pattern. When institutional algorithms encounter genuine supply scarcity, prices do not rise gradually. They gap. A gap move occurs when the price jumps from one level to another without trading at the intermediate prices. The market might close at 31.47 and reopen at 34.20, with no trades occurring between those 2 points. Gaps happen because sellers recognize the demand pressure and simply refuse to sell at lower prices. They wait. The algorithms, programmed to execute within a specific time frame, have no choice but to meet the higher price or fail to fulfill their mandate. Based on the current supply-demand imbalance, 1.6 billion ounces of institutional demand versus 267 million ounces of available registered inventory. Historical gap patterns suggest the market will need to find equilibrium somewhere between 38 and 44 per ounce before supply and demand rebalance. That represents a 20% to 40% price increase from current levels. And it needs to happen within the next 48 to 72 hours as the initial wave of institutional rebalancing begins. But the implications of this price movement extend far beyond silver itself. For business decision makers, entrepreneurs, and corporate strategists, this episode offers several critical lessons about the broader financial system. First, it demonstrates the fragility of price discovery mechanisms in physically settled commodity markets. For decades, the futures market has functioned as the primary price-setting mechanism for silver. Buyers and sellers around the world reference the COMEX futures price when negotiating physical transactions. The assumption has been that the futures price accurately reflects supply and demand. But when institutional capital flows overwhelm the physical market's ability to deliver, the price-setting mechanism breaks down. The futures price becomes disconnected from physical reality. The same dynamic exists in other commodity markets. Lithium, cobalt, rare earth elements, where paper markets set prices, but physical supply chains operate under entirely different constraints. Second, it reveals how algorithmic trading can amplify volatility rather than reduce it. TWAP algorithms are designed to minimize market impact, but when multiple large algorithms execute simultaneously in a supply-constrained environment, they create exactly the opposite effect. They compete against each other, driving prices higher faster than any human trader would. This has implications for any market where algorithmic execution dominates, which is increasingly most markets. Third, it illustrates the difference between liquid financial assets and physical commodities. A pension fund can rebalance from stocks to bonds effortlessly. Both are financial instruments that exist primarily as electronic entries in databases. Supply is theoretically unlimited. New stocks can be issued, new bonds can be created, but silver is physical. It must be mined, refined, transported, and stored. Its supply cannot expand quickly in response to sudden demand increases. As institutional investors increasingly seek alternatives to traditional financial assets, as concerns about currency devaluation and inflation persist, more capital will flow into physical commodities. And the silver squeeze of January 2026 may be the first of many episodes where institutional demand collides with physical supply constraints. For those watching the markets over the next 48 hours, there are specific indicators to monitor. The futures spot spread, the difference between the futures contract price and the physical delivery price, should widen significantly if the analysis is correct. A spread above $3 per ounce indicates severe physical tightness. Delivery notices on the COMEX, formal requests to take physical delivery rather than cash settlement, should surge. High delivery notice counts force the exchange to provide physical metal or allow prices to rise until holders are willing to sell. Dealer premiums in the retail market, the additional cost above spot price for coins and bars, should continue climbing. Premiums above $6 per ounce would confirm that physical supply has become critically tight. This is not investment advice. This is a framework for understanding the mechanical forces driving the silver market at the beginning of 2026. The pension funds have their mandate, the supply constraints are documented, the banking sector has repositioned. When those markets reopen in a few hours, the system will stress test itself. Either the physical supply will somehow materialize to meet the institutional demand, or the price will adjust violently upward until demand and supply find equilibrium. The next 48 hours will determine which outcome prevails. The countdown is no longer theoretical, it is happening now.